Mortgage rate projections for the rest of 24 and 25 right after this. Hey there, guys. My name is Ryan Skaggs, and this is the Mortgage Minute. This channel is dedicated to everything mortgage, real estate, and interest rates. And as we started with, we are going to talk about those interest rates. I've got several charts for you. I'm going to put them up on the screen. We're going to talk about where interest rates are at today, where they're going, and what we see for the future. So let's buckle up and dive straight in. So the first one I'm going to look at, and this is the 30-year mortgage versus the Fed funds rate. Why this is important, it is mid-June, and we just had a Fed meeting. Now, before I get into the actual nitty-gritty, I'd be forever grateful for that subscribe. Click that like button, click that bell icon to be notified, putting out weekly videos on the channel, and I would love to hear from you. So put your comments below. Now let's talk about 30-year mortgage versus the Fed funds rate. So the Fed has basically said that they believe they're going to push their Fed funds rate down. Now they're going to cut at least once later this year, if you've seen any of those headlines, and then where they'd like to be in 2025. And as you can see on the chart, that yellow line, they would like it to be around 4%. Now, where would the 30-year fixed be? That would put the 30-year fixed around 6 to 6.25%. So history will tell us where we've been and likely where we are going. Now, the next one that I want to show you is this is the 2024 forecast and then the 2025 forecast for Fannie Mae, Mortgage Bankers Association, National Association of Home Builders, National Association of Realtors, Realtor.com. So there is all kinds of different economists that are weighing in. So high and low, let's start with the low. I love looking at the positivity here, right? So let's look at the low. Mortgage Bankers Association is looking at the average 30-year fix to end the year at 5.9. So that means from mid-sevens in summer of 2024 all the way down to 6 flat or even sub-6 in 2025. Now, Fannie Mae, on the other hand, is saying, hey, we're likely not going to see as much of that. And they're suggesting that we're going to be in the high sixes, still lower from here, but not nearly what everybody else is thinking in terms of where we're at. Again, I'm going to show you this whole Fannie Mae chart here. And again, they're telling us, where that's going to be. But I'm also going to highlight, and I'll put a little box around here, or at least maybe blow it up on screen. And in this case, I want to show the single family mortgage originations. And what that means is how many more mortgages they think my business, the mortgage business, is going to be doing, how much more financing. If you see from 2013 to 2014, they're suggesting an 18% increase, and then 2024 to 2025, a 20% increase. When you look at 23 to 25, over a 40% increase in mortgage originations. That tells you just how slow the mortgage business has been. Now, not every loan originator like myself would be slow per se, but that can tell you kind of where we've been. Now, moving on from here, one of my points is that, in terms of where interest rates are at specifically, is that if rates move down to that 6% range, we're likely going to start seeing refis in that low 6, maybe mid 6 range. And if you see the chart that I put up here, over 2 million mortgages have rates above 7%. Now, that's mostly concentrated among Gen Xers. This goes from silent boomers, Gen X, millennials, Gen Zs. But you can see that those Gen Xers that have been buying maybe their first home or their second home have a majority of those mortgages above 7%, and they are probably just licking their chops waiting for a refinance opportunity. So that is why we're likely going to see more originations, maybe not more purchases, because our inventory is still extremely short. We have high demand, short inventory. Now, that would lead me to believe that interest rates are going to cause more buyers to come into the market, and that's going to cause your prices to go up. What do you think? Do you think prices are going to go up at the end of 24 into 25, or do you see prices coming down? I'd love to hear from you below. So as you can see there is a large portion of mortgages that are out there that would be very excited to see those low 6 rates. So, and the last one that I want to put out there is that if we see rates move into that, I believe once we catch that threshold of getting below 6%, we're going to see a lot of people from this list. And this next chart that I'm showing you is more than 6 out of 10 mortgages have rates below 4%. So if the rate is below 4%, they likely want to keep that as long as possible. So if they see rates that come down into that 5.5 to 6% range, that could give them the opportunity, or mentally or tangibly, whatever you want to call it, or whatever adjective you want to put there, that very well might get them off the sideline, list their current home, sell it, and move into something new. Because right now there's a large portion stuck at that 3 to 5% range. As you can see there, 33% and 16%, basically half the mortgages sitting down there below that 3 to 5. And if they only see maybe a couple percent bump into, say, that mid 5 range, likely they might be willing to trade up, get that extra bedroom. Maybe both spouses need a home office now. Again, a majority of these people refinanced during COVID, and then all of the employment, kind of remote work, and all these different things change. So it'll be interesting to see. But long story short, every single economist, every single trend is showing lower rates by the end of 24 and lower rates by the end of 2025. I'd love to hear from you below. Hopefully, if you're thinking about purchasing a home, I will hypothesize or summarize with this. I believe there's going to be more buyers in 2025 than there is in 24 because we're going to see that lower rates. I believe we're still going to have short inventory, meaning there's going to be more buyers for that same house, and thus they're going to drive up the price. So if you want to purchase a home in the next few years, I would contend now is a great time. Now, great is a relative term to your individual market. Make sure and consult with your team. But if you want to pay more for it in a year, that would be my hypothetical scenario, is that it's going to cost more, even if the interest rate is lower. And potentially you're going to have to then overpay or pay up even more in the future. So my name is Ryan Skaggs. This is the Mortgage Minute. Thank you so much for tuning in. Make sure and check out the other videos. Stay safe, and we'll see each other again very, very soon.